Hello, MBA 503 students. This is Professor Hazer again, and this is the lecture. I forget which chapter it's on, but I'll tell you in the email. This is a lecture on inventory and cost of goods sold. This is a very important topic because if companies don't sell their inventory, and we're going to find this out in this crisis, if companies don't sell their inventory, they don't survive. So let's just start very quickly here with the part of the income statement, and in a sense the balance sheet. We're going to concentrate on the income statement. The part of the income statement that we'll be looking at in this chapter. And it is also important because when you sell inventory, you earn revenue, and then from that revenue you take out the cost of what you paid to either make or buy the inventory, and then the difference is the gross profit. So let's just review very quickly. I'll say let's go to Apple's financial statements. We've looked at Apple's financial statements many times. So the first thing I'm going to do is go to Apple's financial statements, and then I'm going to take you through an Excel worksheet on the theory and some of the practical aspects on inventory and cost of goods sold. Okay, now why is this topic so important? Okay, let's go to Apple's 10K. Their 10K, I believe this is one of the later 10Ks that we looked at. Let's go back here and see their 10K, and it really doesn't matter. This is their 10K for that was filed in November of 2018. So it really doesn't matter. They're all going to be the same. Okay, so let's go to interactive data. And let's go to financial statements, and then we'll go to the income statement. Okay, now I don't know if you can see because sometimes the pointer doesn't come out, but if you look at September 29, 2018, the net sales for Apple were for that year were $265 billion, which we all know is a huge amount. Okay, but it doesn't matter how much you sell if you don't make a basic profit on it. And that's what gross margin is. Gross margin, the 101 here, is a basic profit. Okay, and so these three lines, sales, cost of sales, we call it sometimes cost of goods sold. That's what I'll be calling it, cost of goods sold. If you take the sales less cost of goods sold, gives you gross margin. Without a gross margin, you don't make money because everything else, all this R&D and selling and administrative, and all these, and even taxes, all these things come out of your gross margin. No gross margin, no profit. Okay, so those are the lines that we're going to be looking at. Okay, now I'm going to go ahead. I'm trying to do this video a little faster than I did the other ones, but this topic is not hard, but it's important. So I'm going to try to do it fast, but and efficiently. Let's see. So now I'm going to take you to an Excel spreadsheet, but keep in mind the lines we're looking at are company sales, which are the number of products that they sell times the sales price, less the cost of sales, which is those same products multiplied by the cost. Theoretically, they should be the exact same product that were sold multiplied by the cost. And this we'll see on the spreadsheet, and that'll give you a gross margin. And all these other fixed expenses are without a gross margin, you just have expenses and you can't survive like it. Okay, so let's go ahead and go to the Excel spreadsheet. Okay, so the Excel spreadsheet that I'm going to use, and I will be sending this one to you like I send all the spreadsheets out, is I'm going to turn myself, I'm going to sort of minimize myself here, this little thing here. Okay, so there's four, in this workbook, there's going to be four worksheets. The first one is inventory theory, which is more or less what I just talked about, but I'll give you a better example. Then there's going to be three methods of calculating cost of goods sold and your inventory. Okay, so let's start with the first one. Okay, now before I start here, I want to make sure that you understand that what I'm teaching here is called all this stuff is called a periodic inventory system. And in a periodic inventory system, the inventory is actually counted. Now, this is the type of inventory system that if you worked in retail for a few years, that what happens traditionally inventory is that retail stores close their doors every 3 months, let's say, and they count their inventory. They not only are counting the pieces of inventory, they're counting how much each piece of inventory cost. Okay, so that's what I'm teaching here, and that's sort of the traditional way of teaching inventory. It's not necessarily, with all the technology that we have now, it's not necessarily the most modern way, but the theory still holds. Okay, so let's go through the inventory theory here, and I'm going to go through what we call the inventory equation too. Okay, so let's say you have a company, and let's just say the company this is their sales. The price, the number of units that they've sold are 32 units. I've tried to be very careful here. Notice that I do not have a dollar mark there. Those are 32 units. And let's assume that these are baseball bats. So these are, we'll just assume that these are baseball bats. Who doesn't like baseball? So let's say this company sold 32 baseball bats. And let's say that they were able to get $30 per bat on the market. So that means that their total sales are $960. Okay, now the theory of cost of goods sold is that when you look at a company's cost of goods sold, and here is cost of goods sold, when you look at a company's cost of goods sold, what you should be looking at, theoretically, is those the exact same physical baseball bats multiplied by the cost of each bat. So let's just go through this. Okay, so these 32 bats in cost of goods sold, those units are the exact same the exact same bats, literally, that people bought. Okay, and so what we're doing is we're taking those same 31 bats, and for now it's just an assumption. Let's assume, excuse me, that the average bat cost the company $12.91 to either manufacture or buy from a vendor. Either one. Take your choice. Doesn't matter. So the average cost of each bat is $12.91. Okay, so what we're going to do is if we take those 32 bats, multiply them times the average cost of $12.91, what we're going to get here is a total cost, the total cost of the goods sold for these 32 baseball bats, those 32, total cost is $413. Okay, now I like this income statement. I'm patting myself on the back here a little bit, but I like this income statement because this income statement shows you how much this company is making per baseball bat. Okay, so it sold 32 bats, and this is the same 32 bats we're talking about. And what we're saying here is that if you take this $32 less the $12.91, the gross profit per bat is $17.09. Now, this is good basic data to have because if all of a sudden that 30, and we've talked about this in class, let's say that there's more competition comes in and the company has to lower its price to meet the competition, that means, let's say the company has to lower its cost, but the cost stays the same, that means that the company's gross profit is going to go down. So this is why this type of basic analysis is so important. And like I've discussed in class, the gross margin, the gross profit ratio really is an important ratio. Companies, if they're prospering and if they have unique products, they will be able to maintain a high price in the market and be able to take a high gross profit. Okay, so we come over here and our total sales for 32 bats, our total sales revenue, I should be saying, is $960. Our total cost for 32 bats at $12.91 each is $413. And our total gross profit is $546.88. Now, every other expense from our perspective is basically operating expense. This could be rent, salaries, depreciation. It includes even non-cash expenses like depreciation, equipment maintenance, building maintenance, all these things. All these things are subtracted basically as flat expenses after the gross profit, and that'll give you your net income. And this is why gross profit is so important. gross profit is so important because if you don't have enough gross profit, if your gross profit goes down, in this case, we have 546.88. That 546.88 is more than enough to cover those operating expenses. But if it goes down, starts going down, you may not have enough to cover your operating expenses, and you've got to start adjusting. That's another course, but you'd have to start minimizing your or decreasing your operating expenses, that sort of thing. Anyway, we come to a net income here of $396.88. Okay, now I'm going to come over here. So that's our basic income statement that we're going to work with now. Now what we're going to do is compare this income statement here with this income statement here. But what I'm going to do is I'm going to write in here, I'm going to go ahead and write in here. I'm going to merge these cells. I'm going to put, this is income statement with full cost of goods sold formula. And I have to make one small correction here. Okay, so we're ready to go now. So I'm going to compare this little income statement here, which is just a basic income statement, with this more expanded income statement. Okay, but keep in mind, as I go through this, keep in mind that we're looking at the same income statement. And to prove it, notice that my sales are the same. My sales are the same in both income statements, $960. Notice that my cost of goods sold is the same. My cost of goods sold is the same right here, $413 is my cost of goods sold. So I'm looking at the exact same income statement. My gross profit is the same. My gross profit is the same, $546.88. There's my gross profit right there. That's the same. And so are my fixed expenses, which are $150 in each one. And so my net income is the same. So my net income is the same. So we're looking at two income statements which are basically the same. But what I'm emphasizing, and as I put in the title up here, what I'm emphasizing is that this income statement here, this one right here, the one to the right, emphasizes what we call the cost of goods sold formula. And this formula is very important because it's going to serve as the basis for all of the three examples that I give you after this. Okay, and keep in mind what we're doing here. What we're doing is we're using a periodic inventory system where we actually close the doors to the store, count the number of baseball bats, and then open the store again. So every 3 months, we close the store, take the inventory, and also compute the cost of the inventory, and open the store back again. A store traditionally used to do this at night. Okay, and so let's start by looking at, and I'll put this in red here. I'm going to put this in red bold. We're going to be looking at the very important cost of goods sold formula. And the cost of goods sold formula is everything under this subtitle which says cost of goods sold. So everything basically between these two subtitles, these items here are the all-important cost of goods sold. Okay, and now a lot of these things for now, the numbers I give you are basically assumed, but in the next example and the next three examples, I'll show you where I'm getting these numbers from. So let's start with this number right here. BI stands for beginning inventory. And what this is saying, so this is BI. beginning inventory. We use BI as the acronym for beginning inventory. What this is saying is that at the end of last period, which is also the beginning of this period, the company closed its doors and counted that they had 24 baseball bats on hand, and it was counted. Keep in mind, I'm going to put over here that this is counted. So the beginning inventory was counted, and the beginning inventory they counted, they had 24 baseball bats on hand. They all cost $12.91 magically. And so their beginning inventory had a value of $309.84. That's the first part of the cost of goods sold formula, is your beginning inventory. You need to have a count of your beginning inventory. The second part are purchases. And when you see the word purchases in this context, accountants use the word purchases, what they're talking about is that these are purchases of inventory. Okay, so these are, when you see purchases in this formula, this means that this is the number of units. This company purchased 41 baseball bats during the year, magically at a price of $12.91. Okay, so what we're saying is that the total 41 bats that the company purchased for its inventory for the purpose of reselling at a price, at a cost, it says price, but it's really cost, dollars, whatever it is, of $12.91. So the total cost of this inventory was of these purchases was $529.31. So we've got two lines so far. First of all, we've got the beginning inventory, which the company already had counted and had on hand at the beginning of the period, 24 units worth $309.84. Then the company went out and purchased 41 units at a cost of $12.91. And so the cost of the inventory that they purchased during the period was $529.31. Okay, now in the formula, in the inventory formula, if you take beginning inventory and add purchases, that gives you what we call your goods available for sale. And it makes sense. What this line is, it's the total goods that you could possibly have sold this period. So what we're saying is if you start with 24 bats and you purchased a number that's 41, the total possible number of goods that you could have sold this period are 65 units. So you could have sold up to 65 units this period, baseball bats in this case. And each one costs $12.91. And so you have a total goods available for sale of $839.15 basically. I'm going to go out here and emphasize that this is the total number of goods that could have been sold. And that's what goods available for sale is. Goods available for sale is your inventory plus your purchases, and that gives you everything. In this case, 65 units, $12.91, $8.39, everything that you could have sold this period. Okay, now, the logic of this formula is if you take everything that you could have sold and subtract out what you didn't sell, that will give you what you did sell. So the logic is you can do two things with goods available for sale. You can sell them or not sell them. If you do not sell them, they end up in ending inventory. That's what this EI stands for, ending inventory. How is ending inventory? How do companies come about their inventory? Ending inventory? Well, first of all, I'm going to write in that it's ending inventory. That's what EI stands for, inventory. So EI stands for ending inventory. And I'm just going to put a couple of characteristics here. The big characteristic about ending inventory is that you haven't sold it. It wouldn't be in your inventory if you had sold it. So this is what was not sold. Okay, so by definition, inventory, ending inventory was not sold. And how is it calculated? Once again, I'm going to put this in here. It is counted. These are the, once again, you come to the end of the accounting period. Doesn't matter if it's quarters, years, whatever. You count your inventory. And what you're saying is you could have sold up to 65. You come to the end of the accounting period and you find out that you did not sell 33 units of ending inventory. Okay, and so what that's saying is what we're doing is we're taking the goods available for sale and we're splitting it between inventory that we did not sell, which are 33 units costed $12.91, which give you a cost of $426. And so, and keep in mind that this is counted. Once again, we know we could have sold those. We come to the end of the period, we count 33. We know we did not sell 33. Okay, now just by basic logic, if you did not sell 33, which were worth $426.03, if you did not sell those, that means that anything that is no longer there, you did sell. And the items you did sell are your cost of goods sold. So what we're saying here is you had 65 units available for sale. The number of units that you did not sell, because you count them, they're still sitting in your inventory warehouse, are 33. So that means that you did sell 32. And that is the basis for your cost of goods sold. What you're saying here is that you sold 32 units. And by the way, notice that the 32 units in sales are the same number as the 32 units cost of goods sold. That is not a coincidence. That's the way it should be. Because like I said, it's the same physical units, theoretically, that you should sell. And so cost it out at $12.91. That gives you $413.12. Okay, and notice that $413.12 is the exact same number that I have here. I'm just taking this income statement over here and kind of exploding it and giving you more of the detail. Okay, so here's what we're saying is that, let's go over the formula again. Take your beginning inventory, and it is counted, so in any problem, it should be given to you. And then add all the purchases of inventory that you bought from any vendor. We're assuming obviously the same vendor because everything's at $12.91. So we're assuming beginning inventory of 24 plus purchases of 41. That's going to give you total goods available for sale of 65 worth $839.15. Now, the whole point of what we're going to do here is we're going to do in the examples that are coming up, we're going to split goods available for sale between the units that you did not sell, which are ending inventory, which we're costing here at $426.03, which are $12.91 each. So we're going to take the 65 and split it between ending inventory and cost of goods sold. Okay, sorry. It seemed like the computer was freezing up. Okay, anyway, sorry for the four-letter word almost. But anyway, so you have cost of goods sold 32, costed at $12.91, gives you $413.12. Notice, though, keep in mind where cost of goods sold comes in on the income statement. You take the $960, you take out the cost of goods sold of $413.12. That gives you your gross profit of $546.88. And by the way, like I keep saying, this is the exact same income statement. And I'm going to take this line out here. Okay, less your operating expenses gives you $396.88. Okay, now that's a simple enough example, but this is going to be the example that we use for the rest of for the three examples that were coming up. That's simple enough. The only problem with what I've been assuming here is that I'm assuming two things. Number one, I'm assuming that the sales price hasn't changed, and we're going to keep that assumption. Sales price stays at 30. What is a very unrealistic assumption, though, is that this is an average cost. I've been saying that this is an average cost. That $12.91 is an average cost. Okay, so but we're assuming that there's no inflation and no deflation. So we're assuming that the cost hasn't changed, and that's why we've got to use one of the three methods for inventory that that I'm about to show you. Okay, so here's your basic setup. And we're going to be using basically the same setup to go through the three examples. Okay, and the first example basically is what we just did. And so I'll go through it, and then, so the first example is going to be average cost. That's, some people call it a weighted average cost. That basically, you'll see that we've already done that. The next one is going to be first in, first out, or the famous FIFO. And the last one is going to be last in, first out, or the famous LIFO. So some of you who've been in business, or you read the text, you're going to be reading about first in, first out, and last in, first out. And I'm going to emphasize in this chapter just the basics of inventory, because if you know the basics, everything else is kind of an extension of that. Okay, so let's start with the first example, average cost. Okay, now we've got some data here. And let's assume that this is your inventory. These are your inventory records here. So those are your inventory records. Okay, and they're very rudimentary records, obviously. Okay, and I'm going to have to make a small correction again, but it's no big deal. Okay, so let's say that our inventory records of bats, baseball bats, are that on April 1 of this year, our beginning inventory was 24 units. Keep in mind that I'm using the same data. I'm recreating the same thing for you. Our beginning inventory was 24 bats, and they were, let's say that there's a bit of inflation, so we had purchased those bats at $12 each, and so here's the cost. This is the cost right here. And so the total, I'll just put total dollars. The total cost of your beginning inventory was $288. Okay, now on April 5th, this company purchased an additional 15 bats. So the purchases aren't done at once, the purchases are done in total. Okay, so the company purchased 15 bats at a cost of $13 for a total cost of $195. So that's your first purchase. Then we come to the second purchase, and the company purchased 16 bats at a cost of $13.50. So you get a total of $216 for the second purchase. So far we have a beginning inventory of $288, one layer of purchases at $195. Notice there's a bit of inflation here, $13. Let's assume all the bats are the same. And then it's pretty big inflation. Okay, and then the third purchase is in April. It's $216. There's 16 bats, $13.50 each. Cost was a total of $216. Now their inventory records are showing, excuse me, that the company sold 20 bats on April 19th. Now this is not cost. That's a sales price, $30. That's a sales price. Okay, so I should put here up here cost or sales price, cost or sales price, or I'll leave it off. I'm just going to say right here, just notice that that's $30. That's a sales price, obviously, it's much higher. And that's the sales price that I've been using all along. It's that $30 sales price. Okay, so the company sold $20 or $30 per bat, so they made revenue of $600 in their records. And then between these two sales in April, the company purchased another 10 bats at $14. And so that gives them $140 is the total amount of the cost of that purchase. Okay, and finally, the company sold on April 30th, last day of April, 12 bats, $30 each, for $360. Okay, so that could be a company's kind of inventory records. They probably would not show the sales price. I'm putting it in there just to keep this compact, but they certainly would show the cost of bats coming in and out. So So anyway, so that's the basic data. Okay, now I'm going to go down here just a little bit. I'm going to kind of scroll down here a little bit. And I think I've got everything in the screen right now in this example. Now notice once again, I'm going to calculate goods available for sale. Okay, and goods available for sale are exactly as I calculated back here in this example here. Goods available for sale are beginning inventory plus purchases. That gives you your total goods available for sale. Okay, this table is the same calculation, but it's been broken down a little bit. Okay, so your goods available for sale on an inventory record level, not financial statement record level, but an inventory record level, in your inventory records, here's your goods available for sale. It's going to be the same thing as before. Beginning inventory plus all your purchases. Okay, so notice that all I'm doing in this table right here is I'm pulling, in this goods available for sale table, I'm just pulling my beginning inventory and all the three purchases, the April 5th purchase, the April 11th purchase, and the April 24th purchase. So let's go over here. So my beginning inventory, I pulled all the rows come from the second row there. My April 5th purchase is 15 bats. They all come from D3. You'll notice when I say the worksheet, this is just a copy of the row D3. My April 11th purchase, they're coming from the fourth row, C, D, E4. They're coming from the fourth row. And then finally, my April 24th purchase is coming from the sixth row there. Okay, so this is the average cost method. So in the average cost method, you first calculate your goods available for sale. So this is your goods available for sale, and they're basically you have 665 units total that you could have sold. So that's a total. So in units, your goods available for sale are 65 bats worth, and there's some rounding error in here. It's like 15 cents rounding error, $839. So your goods available for sale worth $839. Okay, now here's how we're going to handle this in the average cost method. It is the easiest of the three methods. The way you calculate your average cost is you just take, let's just go down one thing here. This is your average cost. Just take your total goods available for sale in dollars, and I'm going to point this out. That's that number right there. There's your goods available for sale in dollars. Okay, then I'm going to give you, then you divide by your goods available for sale in units, and you can see right there that that's the goods available for sale in units. And if you divide, it's just dividing basically this number by that number. Once again, I'll point these out. There's your goods available for sale in dollars. Divide by your goods available for sale in units. Okay, and that right there gives you your average cost of $12.91. Okay, and that is exactly the average cost that I was using in the other worksheet here. Now there is a small calculation I want you to do. I want you to be sure, because some people get lost here. To me, it's one of those things that are obvious, but I want to make sure that you understand where I'm pulling these numbers from. I'm going to just do this. Let's say total units available for sale. So if I'm looking at this calculation, I know that my total units available for sale is 65 units. Okay, then if I take those 65 units and I subtract out, I'm going to say total units sold. These are going to be key numbers for all the examples coming up. If I take my total units sold, now my total units sold, I can take it from a lot of places, but my total units sold are the April sales of 20 units plus the That's the April 19th sales of 20 units, plus the 12 units that were sold on April 30th. So the total units that were sold were 32. That's how I'm getting those. Okay, now if I put a line here, and this is all, you can reverse this calculation, but if you take the total units that were available for sale, which is, and I'll go back to this number, that number right there, and I subtract out the total units that were sold, which are the sum of those two numbers right there. I subtract those two numbers. That right there will give me my ending inventory. Okay, and those two numbers, units sold and ending inventory, are going to be very important in the next two examples, in my FIFO and LIFO examples. Okay, so I decided to do this calculation right here before I got into those, so just keep those numbers in mind. Okay, anyway, finishing this example, we've calculated before total goods available for sale of 839, which is that number right there. Total goods available for sale in units, which is that number right there. And those two give us an average cost of $12.91. Okay, and in the average cost method, once you get that $12.91, it's just a matter of recreating this same income statement. You'll notice that this income statement here is the exact same as this income statement that I have here, right here. They're the exact same income statement. So once you get your average cost, you're on the way. Once you get your average cost and you know what your purchases, your inventory levels are by counting, and this should be, I'm going to change this. This should not be dollars. That should be just units. Let's see here. Number. I'm just going to go just a general number with no units. Those should be units right there, not dollars. And this should be negative. That's negative equal to that. Okay, so anyway, so there's the corrected income statement. But anyway, so all you've got to do is, once you've got your $12.91, you know that you sold 32 units. There's 32 units. You sold 32 units at a price of 30. That's $960. Then you know that by counting, you know you've got 24 units in beginning inventory at $12.91, which is equal to that number right there, $12.91. That gives you your beginning inventory. Add your purchases. Now your total purchases, I'm going to be a little more specific so that you'll know where I got that from, and I think you should be able to figure it out. But your total purchases are just the total number of units that were purchased. So your total purchases is the 15 on April 5th plus the 16 on April 11th plus the 10 on April 24th, and that gives you 41. So your total purchases, I didn't originally have it set up that way, but your total purchases are your total purchases on those 3 months right there. Now we're assuming an average cost, not assuming, we calculate an average cost of $12.91, okay, which, by the way, comes from, that $12.91 comes from somewhere. Should come from here. Yeah, I'll just leave it off. It comes from, it's just the $12.91. It's equal to that cost right there. Anyway, so you got your $12.91 that you bought the 41. This is an important thing to know. That's where you got the 41. Okay, that gives you a total of 65 units that you could have sold. That's $839.15. If you subtract out, now these amounts are subtracted out. I'm just doing it like they do in life. You know that financial statements, real life, they don't use pluses and minuses. But I just subtracted that out. So I subtracted out 32 units at $12.91. And that gives you $426.03. So if you subtract, I want you to look at this equation here. If you subtract out the $839, which is what you could have sold, less your ending inventory, which is what you didn't sell. That's going to give you your cost of goods sold right here. There's the equation right there. I'll let you look that up, which is $413.12. Okay, now we're going to subtotal this. Let's go ahead and subtotal this, because this is, if you take your cost of goods sold and subtract it from your sales of $960 less your cost of goods sold of $413.12, that gives you your gross profit of $546.88 less operating expenses, gives you net income of that number right there. But keep in mind that your cost of goods sold calculation is beginning inventory plus purchases, gives you goods available for sale, subtract out, I'll try to put it at least here. This is a minus. That's going to be a minus right there. Do this right. And that's going to give you your cost of goods sold of $413. And then if you take your cost of goods sold, which is what you did sell, and subtract it from the $960, that's going to give you a gross profit of $960 less $413, gives you that gross profit of $546.88, and your net income is just the difference in those numbers right there. Now I put a negative sign in there, but that's your net income right there. Now, okay, so that is the average cost approach. I want you to keep one thing in mind as I go to the next two approaches, because if you keep this in mind, it makes this whole thing a lot simpler. If you look at goods available for sale, it's 65 units at worth $839.15. Those are the same numbers rounded. There's 15 cents difference, but I got that. Your goods available for sale are $65 and worth $839. I want you to remember, this will always, I'll even write it down. This will be the same under all three methods. And the reason that I'm emphasizing this is that you're going to see it doesn't matter if you use weighted average or the average cost method, this method here, the average cost method. It doesn't matter if you use first in, first out, or last in, first out. This number here, that number there will not change. So the only thing we're doing in these methods is finding different ways. We're going to have different assumptions to divide goods available for sale between ending inventory and cost of goods sold. So you're going to take what everything could have sold, and we're going to, based on assumption now, we're going to have, we're just going to come up with different methods for dividing that $839 between ending inventory and cost of goods sold. What you could have sold, total available sale between what you did not sell and what you did sell. Now you may be asking, why do we do that? We do that because under periodic systems, a lot of times stores and businesses don't keep exact records. With technology, point of sale and all that, I'm sure some of you know this stuff because you're in business. You can probably do it. But these assumptions still hold, and if you read financial statement footnotes, they use some version, sometimes of first in, first out, or last in, first out. Okay, so let's go ahead and go on to our examples of first in, first out, and last in, first out. And they're all going to be based on all this data in here that we've used. And I want you to remember one thing. That number does not change. The only thing that we're going to change in each one is how you separate that number between ending inventory and cost of goods sold. Okay, so let's go in to our first in, first out example. Okay, now these two tables are the exact same tables that I've been using over here. So these are basically your inventory records. Okay, so I've got these two tables right here. Okay, and so this is your inventory records. These are your inventory records. Okay, and this is the same cost of the goods available for sale table that I did before. Okay, now, so just keep in mind that these are your inventory records, which I had here, exact same table, and the second table, goods available for sale, are the exact same table. 65 units that I could have sold. Your 65 units that I could have sold, and the total cost of those units was $839. So the total cost of those units. Okay, so what I'm going to do is just go down here a little bit. And I think everything we're going to need, more or less, I'm going to go ahead and just see if I can shrink this just a little bit. So you should still be able to see that, but I want to make sure that you see where these numbers are coming from. Okay, and I'm going to go ahead and I'm going to go ahead and erase these numbers right here so you can see where and I'll send you the worksheet, but I'm going to erase these numbers here so you can see where they're coming from. Okay, I've got my income statement format there, and I've got my my calculations to the left. Okay, and this is actually first in, first out. This is the first in, first out example. And I'm actually going to erase these to just erase these to show you where I'm getting these numbers from. Okay, let's go back up to this table right here. I'm going to recreate this for you, so to speak. Okay, so here is my goods available for sale calculation. Now, these are first. By logic, your beginning inventory, think of it as a line. Think of goods available for sale as a line. So your beginning inventory is first. Your beginning inventory is absolutely first. Okay, and first in, first out. Look at the title. First in, first out. So you could really call this first in, cost of goods sold. And the reason I like calling it first in, last cost of goods sold is because under this assumption, we have 65 units with a cost of $839. We're going to assume that the first one's in, that the first layers that came in, starting with your beginning inventory and then moving through your purchases, we're going to assume that the first ones in are the first ones that were sold. That's what we mean by first out. First ones in are the first ones sold, which represent cost of goods sold. So in the FIFO, the cost of goods sold is going to come from your earlier layers. And that makes sense under some assumptions, but under FIFO, your cost of goods sold is going to come from your first layers. Okay? And then your ending inventory, so your cost of goods sold is going to come from your first layers here. And your ending inventory is going to come from your later layers. That's why you call it first in. These are the first ones. First out. So we assume that these 24 go out first, and then maybe these 15 go out then, and then if we don't sell everything, then the 16 and 10 are probably going to be in your inventory. So the first ones in are the first ones out, or the first ones in are the first ones that are going to be sold and in cost of goods sold. Okay, so let's see what I got here. Okay, so we know that we sold. Going back to this example here, keep these numbers in mind. We sold 32 units and had 33 in our ending inventory. Okay, so on April 1st, let's do this. Let's go ahead, and in this table, here's what I'm going to do. We're going to assume we know we sold 32 units, and 32 are what should be in cost of goods sold. So we know that on April 1st, we sold 24 units, and we know that those units had a cost of $12. Okay, so those units, that layer was 24, gives us 24 at 12, that should be times, obviously, excuse me, $288. So we know we sold 24 units at $12 each. So that was $288. Those are all gone. That's the first layer. And that was your beginning inventory. Okay, now we know from this previous calculation that we sold a total of 32 units. So what we've got to do is, if we know that, if we're assuming that the beginning inventory is sold first, and that's 24 units, we're going to have to take, and we know we sold 32 units sold, less the 24 units that were sold. We're going to have to split the April 5th purchase between goods available for, or cost of goods sold, and ending inventory. And here's how we're going to do it. We know we've got 32 units total that we sold. That's what I've talked about in the previous two worksheets. Okay, now to get to 32 units, we've already sold 24. We're assuming those were sold first. Then we're going to assume that we're going to sell 8 units from the April 5th layer, because the 32 units less the 24 units out of beginning inventory means that the next 8 units came out of the April 5th layer. So I'm just going to write in here 8 units right there. So that gives you a total of 32 units that were sold. And the reason that's important is because this layer has to be split. So we sold a total of 32 based on these calculations back here and everything. We know that 24, the assumption is first in, first out. So you definitely have to take the 24 units, and those by definition, first in, first out, were sold. And then we go to the next layer. If we get up to the 32 units, that's called the split layer. We have to split it. So we're going to assume of the 15 units, 8 were sold, and we'll assume actually that 7 weren't. That will be ending inventory. We'll get to that. Okay, so if we just copy this down, we are going to get total. We're going to get cost of goods sold of $392 are our cost of goods sold. It's $392. And we did that by using the first in, first out assumption. These units, the early units are first in, first out, first in, first sold. First in is cost of goods sold. Okay, so we take 24. We know we sold 32, so we take the 24. That cost us $288. That wasn't enough to get us to our 32 units, so we took 8 units from that layer right there, that $13 layer right there. So our cost of goods sold are $392 is your cost of goods sold here. Okay, now let's get to our ending inventory. Now notice I have 3 dates for the ending inventory. Whatever's left after assuming that we sold 24 units from the beginning inventory and 8 units from April 5th, whatever's left is going to be our ending inventory. Okay, so the number of units that we're going to take from April 5th are 7 units. We're going to assume that 7 units came out of those 15. Basically, those 15 units, 8 of those were sold and 7 were not sold. Okay, so 7 are going to be costed at $13. That's going to give us 7 times 13. That's going to give us $91. Okay, and then we're going to go to then what we've got left over. So we're assuming that 7 units come out of there, and then the whole 16 are going to come out of there because we don't have any. They're left, and then 10 because we probably counted 8 of these, all 16 of these, and 10 of those. Okay, so anything that has not been sold, we sold 24 from beginning inventory and 8 out of the April 5th purchase. So we got that 24 and 8. So anything left over, including the 7 from the April 5th, anything left over is going to be ending inventory. So all of those are ending inventory, and All of those are in inventory. And notice that we come to a total of 33 units right there. Okay, so here's what we're going to have is those 16 units. The cost of those 16 units is $13.50, and the cost of those 10 units are $14. We're just going to go ahead and extend those out. Okay, and so we have, this is your ending inventory right there. And I'll put an arrow there. That's your ending inventory there, $447. And that is your cost of goods sold. Okay, so what we've got is we've got cost of goods sold of $392 based on selling these 24 and 8 of those 15. And we've got ending inventory, assuming we sold 7 of those 15, and then all those 16 and all those 10. And that's based on first in, first out. As you can guess, last in, first out is the exact opposite. Okay, so let's put together our statement here. Okay, let's put together our income statement. Okay, and so we'll go ahead and do this. Okay, we know that our sales, we're not going to use units here, but we know that our sales, I'm just going to go ahead and take a look at our total sales again. Our total sales throughout these examples has been $960. So I'm just going to go ahead and put in $960, and that's the $30 sales price. Okay, now our cost of goods sold calculation. Here is our cost of goods sold calculation again. Okay, our beginning inventory right there is equal to $288. Our purchases are equal to $195 plus $216 plus $140. So our total purchases are $551. So our total goods available for sale are $288 for beginning inventory plus purchases of $551. That gives you $839. And let's go back to what I said before. That $839, that doesn't change. That doesn't change for average cost, first in, first out, or last in, first out. That does not change. That's $839. The only thing that's going to change in all this is how we split that $839. I'm going to go ahead and take this and just maybe push it out there. Okay, so we've got goods available for sale of $839. Now, the only difference, like I keep saying, between all the three methods is how you split this $839. Under this method, we've got $839 is the total amount of inventory that we could have sold. Okay, now what we're going to do is we're going to subtract out our ending inventory, which is what we didn't sell. So our ending inventory under FIFO is right there. Okay, so that's 447. Okay, and so we're going to have a subtotal here. We could have actually take this out. Probably be better to put this here. We're going to put a subtotal here, and that subtotal is going to be your cost of goods sold. So we're saying your goods available for sale are $839, which is that number right there. What you didn't sell was $447, which is equal to that number right there. Now, what you did sell is equal to what your goods available for sale, what you could have sold, minus what you didn't sell. So your cost of goods sold is equal to $392. Notice that these two numbers here, the 447 plus the 392, give you your goods available for sale. These two numbers should always add up to goods available for sale. Okay, so anyway, so your gross profit ends up being your total sales of $960 minus your cost of goods sold of $392, which gives you a gross profit of $568. we've been just assuming operating expenses of $150. We'll do this to be, I always love it when it does this. Just do this. Sales, currency, 2, fine. Okay. So 568 less the 150 gives you net income of, equal to 568 minus 150, gives you net income of 418. Now I want you to notice something, that the goods available for sale, this is always the same. Goods available for sale is always the same. What differs under each method is the gross profit. So, well, this is different under each method. So that one's different under each method. And I can just go ahead and copy, because cost of goods sold, so I'm going to copy this down. These three things are different under each method, and net income is different under each method. So this brings into question, I'm going to make 2 points. Number one, you can manipulate income. If you choose one method over another, you can actually manipulate net income. So the net income for first in, first out is $418. If you chose to do average cost, it's $396. So wouldn't it be nice if you could use first in, first out to report your income to shareholders and then average cost for your taxes? Well, that's not what companies did, but they came close to doing that. So keep in mind, that's one thing. The next point I want to make is, why would you use first in, first out? And I guess I'm going to go ahead and ask you that. It's a little question I always have for homework. And I guess the specific question I'll be asking is, what type of product would first in, first out represent? What would a first in, first out flow be good to represent? What type of product? Products that come in first and you get rid of them as fast as you can, and those are the ones you sell first. The first ones in or the first ones out. Okay, now let's go on to our last example, which is last in, first out. And it's, as you could guess, it's the exact opposite of first in, first out. Okay, so let's come over here, and this is last in, first out. And I'm going to go ahead and do the same thing that I did for the other example, because I want you to see where the numbers come from. I'm going to send you this exact spreadsheet, but I want you to be able to see where these numbers come from. So I'm going to go ahead and erase these numbers here. We have the same tables. I have the same tables. You've got your inventory records and your goods available for sale. And that was off anyway. Okay, and so let's go ahead. Now, last in, first out, the assumption is that once you get your goods available for sale, and I want to reiterate, these are the same tables that I use back here. I use the same tables here, and I use the same tables there. So if you go back here to the average cost example, I've been using the same table, same data all the way along. Okay, so I've got my goods available for sale, and I'm going to go ahead and put together my calculation of cost of goods sold and ending inventory. Okay, so let's see if I can shrink this down. I'll shrink it down when the time comes for. Okay, so under last in, first out, it's the exact opposite. Under last in, first out, the cost of goods sold comes from the last units first, and the ending inventory comes from up here. So ending inventory comes from here, and cost of goods sold comes from here. And I'm just going to go ahead, that's COGS, and just so we don't confuse things here, I'm just going to go ahead and say put this in here, that the ending inventory comes from the first layers, last in, first out, and the cost of goods sold comes from the later layers. Am I typing together here? Gotta get rid of that thing. I'm putting those in so you don't confuse that with the income statement that turned out right there. Okay, so anyway, so your ending inventory comes from these layers, and cost of goods sold comes from those layers, which is different than first in, first out. First in, first out, your cost of goods sold came from the early layers, and then your ending inventory came from these last layers. Okay, so let's do last in, first out. Okay, so let's compute our cost of goods sold. I always like computing cost of goods sold first. Now keep in mind that we sold 32 units. So we've got to work up to a total here of 32 units. Okay, so let's work up the units first. Last in, first out. We sold all of those. Last in, first out. We sold all those. We got to get up to 32. Then we know that we're not up to 32 yet. Okay, so we're up to 26 units. So we know that we sold the last units in were the April 24th purchase of 10. Got rid of those. We sold another 16. Those we got rid of those. And then we have to get up to 32 units. We're at 26 units. So we know that in order to get this 26 up to the 32 units that we know were sold, we know we've got to take 6 units, if I'm adding up right, out of the split. Once again, we're picking on April 5th. We've got to take 6 units out of the April 5th layer. Okay, so now all we've got to do is put in our costs. These units came in at $14 a piece. These units came in at $13.50, and the April 5th units came in at $13. Go ahead and extend these out. And your cost of goods sold, and this is cost of goods sold, your cost of goods sold in this case came to 32 units you sold, and your cost of goods sold is $434 here. Okay, and so last in, first out, last in, first sold is the best way to look at this. Okay, so you've got 100, we sold, we're assuming that these units were sold first, then those units, and then 6 of those. Okay, so we got those right there. And then whatever's left over should add up to 33 units, which are our ending inventory. And it should, because here's our ending inventory calculation here. Now I'll shrink this down a bit. Okay, so our ending inventory calculation is we took 6 units from the April 5th purchase. So knowing that there's 15, there's 9 units left over. Okay, and then we know that the beginning inventory were 24. Okay, so this is your ending inventory. Your ending inventory consists of 33 units, and we've been saying all along, you sold 32 and did not sell 33 units. Okay, so now we're going to go ahead and finish our calculation. On April 5th, those units were all $13, and on April 1st, which is your beginning inventory, those units were all $12. Okay, and I'm going to extend these out. I could just take this formula down. I'll just take this formula and copy it down. Okay, so we've got cost of goods sold under last in, first out of $434, and we've got ending inventory of $405. Notice that 434 plus 405 adds up to 839 goods available for sale. That's how you know how you're correct. Okay, now let's go ahead and put together our income statement. Once again, I'm really not going to need a unit price and all that. Okay, so our total sales, if I recall, are 9 under all assumptions. Our total sales are equal to, get this down here a little bit. Our total sales have been equal to, all along, $960. I'll straighten this out. I'll clean it up later. Our cost of goods sold section is going to be right here, is our cost of goods sold section. Okay, and let's see here. We can get rid of this column here. Let's go ahead and get rid of this column here. Delete this column. We'll see. We'll just put it there like this. We'll put the totals here. I made out another column. Okay, so anyway, we know that our beginning inventory is $288. Excuse me, our beginning inventory we know is $288. Once again, we know that our purchases are going to be equal to the sum of the 3 purchases for this accounting period. So those are going to be equal to, so our 3 purchases are going to be equal to the April 5th purchase plus the April 11th purchase plus the April 24th purchase for $551. So once again, goods available for sale is equal to beginning inventory plus purchases, which gives you $839. Okay, now I go back to the same point that I've been trying to make before. Let's see if we can get these income statements kind of lined up too. Okay, not a bad thing. Okay, so we'll go back. I want to emphasize that under all 3 of these methods, the goods available for sale is $839. There's $839 for LIFO. There is $839 for FIFO, and even weighted average, we had goods available for sale rounded of $839. Okay, so that's reality. That doesn't change. What you pay for things and when you buy them doesn't change. What's changing is how we split the $839. Here we split it $426, $413. Under FIFO, we split it $447, $392. And under LIFO, we're going to split it differently too. Okay, so if you take the $839, and then we're going to take our ending inventory. Our ending inventory here is going to be $405. Make sure we get that right. Our ending inventory is $405. Okay, and we'll just subtract it out in the equation. I'll show you the equation. Okay, and so our cost of goods sold is going to be goods available for sale, which is what you could have sold, less what you didn't sell, which is $405. So our cost of goods sold is $434, which, by the way, is also equal to that number right there. That number is equal to that number. All you're doing is taking that 39, splitting it 434 to cost of goods sold and 405 to ending inventory, which are these 2 numbers right here. Okay, so finally, gross profit, and I'll clean these numbers up in a second. Gross profit is going to be equal to the 960 minus your cost of goods sold, gives you gross profit of $526. Okay, and we'll compare that in a second to first in, first out. I'm just about done here. I'm just going to clean it up and then we'll do a quick comparison. And I'll send you some questions later on. But with the homework, you're going to just do my business course homework. And what I'll do is I'll ask you a couple of questions. And then your operating expenses, we've been assuming all along that they're $150. We'll clean that up in a second. So your final net income here, these are $150. So your final net income here is $526 minus $150 gives you $376. Okay, now let's clean all this up. Let's get it at least in the same format here. Currency to Dollar sign G. I hope the dollar doesn't sink with everything we're doing with it. Okay, so you get a net income of 376. Okay, now I'll be asking you a couple of questions on this stuff with or they may be part of my business course. I'll have to take a look at those. But I want you to notice one thing, and this will always hold true. When prices are rising, in this example, prices are rising. When prices are rising, under last in, first out, you will always get cost of goods sold, which is higher than first in, first out, and you'll always get the gross profit and net income that are lower than first in, first out. And that's always going to be true. And somehow, in a very soft way, I'm going to ask you why, but you may already see this. Okay, so keep in mind that you've got net income of 376 under LIFO, in conditions when prices are rising. Now let's go back and look at first in, first out. Under first in, first out, my rule came true. Under first in, first out, what I just said was if prices are rising, like here, your cost of goods sold will be greater under LIFO, and your gross profit and net income will be less under LIFO than under FIFO. And that's come out to be true. Under first in, first out, we use the exact same assumptions. Your cost of goods sold are less. It's 392 here, and it is 434 here. So our cost of goods sold is less than under last in, first out, and our gross profit and net income are actually greater. And that always happens when prices are rising. And finally, the final word I have to say, because I'm just about finished here, is you can use average cost, but average cost always turns out in the middle. So if prices are rising, you'll notice that you get a net income of 376 here, which will always be less under LIFO if prices are rising. And then we go over here first in, first out, you'll see the LIFO income is less because the cost of goods sold is more under LIFO. And you'll notice, if this worked out, that the income under average cost turned out to be between. Okay, the last question I have is the same question I asked under FIFO. What type of good would be representative of a last in, first out cost flow? Otherwise, for what type of good would you sell the latest units first and then actually build up maybe layers of obsolete inventory? We don't know yet. Anyway, so I'm going to stop this recording and I'll send it over to you, and hopefully this will help you with your homework. I'm going to get this to you as fast as possible, and be patient with my grading. It's going to take me not too long, but a few more days to grade because I'd like to get these lectures done. Anyway, I hope everybody stays safe. They did say today that fortunately they did say that there's that some company, Abbott Laboratories, came up with a nice vaccine or nice test. I wish it were a vaccine, but a nice test that you can do at home. So maybe our country's getting its testing together. So anyway, good night. Take care of yourselves, please.